Hello and welcome to Money Talk. I'm Kim Parley. Oil prices have been under pressure recently as markets react, let's call it cautiously, to OPEC's pledge to cut production in late November. There are already some countries within the cartel that are unlikely to commit to those cuts. Joining me now with more is Thomas George. He's portfolio manager of the TD Resource Fund and the TD Precious Metals Fund. Where you been? We haven't talked in a while.
It's been a while.
I know.
I've been waiting for this moment.
I know.
You know, we needed the puck to drop.
Exactly.
The action to happen.
The puck has dropped.
The puck has
on.
dropped. Yeah.
So I was going to say I haven't talked to you since OPEC came out. So we've been here before. I mean, I've reported on this for 13 years.
Yeah, we've been here before. Now we felt like it all fell apart, and now finally, it feels like action is back, right? And I put out a note before this quasi meeting turned into a very official meeting. And the one thing I said, what's interesting here that the narrative has changed since we entered this downdraft since 2014, and the real change has been Saudi's attitude. And that has been the real catalyst for why we think the market, there's something real behind this, because Saudi has really initiated the talks. They're the ones leading this. They're the ones trying to put it all together. And when they're the glue factor, things do happen. Okay, well, let's bring up a chart here for, I think this is called the OPEC quota versus actual OPEC production. I'm going to call it the what they say versus what they do graph. Yeah, love it, yeah. We'll bring it up in just a second. It's on the way. But tell me just at a high level when this comes up, what are we seeing here? Are we seeing basically that, they produce more than they say they will? Yeah, so, no, it's another one. So basically this is kind of a, what should we expect from them? That's the one big one. So this is really good. Basically the blue line is what OPEC says is the quota at any given time. And the yellow line is effectively what they do. So there's a cheating quotient here. So you can see the yellow line is never below the blue line. So so needless to say, on average, that yellow line is somewhere between 500,000 to 1 million barrels over the actual quota. But I won't point to that exactly. What I will say is interesting here is the trajectory. So you see when the blue line falls, production actually falls. When the blue line rises, production rises. Now, they're up a little bit above that. But what I would say here is what's important to note in this just whole scenario here, what enables that production to decline? It's one country, it's Saudi. So the fact that Saudi's initiated it, they're suggesting let's bring it down, the midpoint somewhere in 500,000 barrels. Maybe the high point is somewhere closer to 1 million. But needless to say, they're the one initiating it, and they're the only ones who take barrels off the market anyways. Yeah. So we should just watch them. We should just watch them. So from their perspective, I think they feel that they're at a point right now where initiating such a grand bargain makes sense because they feel like everyone's going full throttle. What about we're talking about they are talking about cutting about 1 million barrels a day. Is that significant? Yeah, so I think the midpoint, if you average it all out, it was something like, it was something like 500,000, but, high end, closer to 1 million. That's enough. It absolutely is enough. So the real question is, how does this play out? We think that this is a critical juncture for us to watch closely. Our view was that the market starts to balance out somewhere later half 2017. Now, with this interjection of, say, let's just assume that midpoint, then you're looking at something like bring that balancing point forward by about 6 months. So that's what this gives us here. And so the market will discount accordingly. Let me, you brought another chart here about this rebalancing pathway. And again, I think people, anybody who works in kind of in a corporate environment will recognize these are source of change kind of charts here. But tell me what we're looking at and why you think this one's important. Yeah, so this is our waterfall that, that we update regularly just to try to give us a flavor of the snapshot where we started the year, in terms of supply-demand mismatch, and where we're effectively going to end the year. Now, this doesn't include anything regarding OPEC, but you can overlay that, right? So we started the year with a pretty large supply-demand mismatch. So supply was in excess of demand by 1.5 million barrels per day. That's the bar on the left. Exactly. So that's that gray bar. Then you add on the extra barrels that come onto the market. So Iran, we knew Iran was coming on. They're going to, when all said and done, they're going to average out an extra 600,000 barrels per day. day this year, and then you add on another 300,000 barrels, bits and bobs from the rest of OPEC. So that's that top line. Then you have to take away how much demand has increased. Now, demand's actually been very good this year, so it's anywhere between 1.2 to 1.3 million barrels per day. So that's taking away from that. Then also, U.S. shale production is down. That's critical. That's a critical piece. We needed to see that happen. And when all said and done, by the end of this year, that's going to be an average about 600,000 barrels that's off the market. And then finally, other non-OPEC regions, another 200,000. So what you're left with is this supply-demand mismatch as we stand today, here and now, is somewhere in the range of 300,000 barrels per day. Supply is in excess of demand. So that, in our view, is a very healthy situation if it wasn't for the monstrous amount of inventory.
Yeah.
But that alone is a great snapshot of where we are today. And so if you were to say, well, now let's overlay the OPEC, let's call it 500,000 barrels. So you take away 500.
You're now negative 200.
Now you're negative 200, and that's a good thing to get inventory down.
Yeah.
So the whole point now, the game plan for Saudi is just to get that inventory down. And I think that one point I really did want to bring about why Saudi is here today and why they're really pushing, it really comes down to their fiscal situation.
Yeah.
They've been running a very large fiscal deficit. Now they're going to enter 4 years of fiscal deficit, and we ran some interesting analysis. Just our very good credit research team. We're looking at just how else can we look at this? What is Saudi thinking? If we were to look at $40 per barrel, that can be a realistic case.
Yep.
Saudi's got to think about it this way too. Going out to 2020. $40 per barrel, and assuming that they did, any sort of, changes within the country just to reduce, their overall fiscal deficit, it still increases their debt to GDP in a range of somewhere close to 50 to 60%.
Wow.
From very low levels, like around sub 10% right now. So if you think about where that would leave them by 2018, 2019, in that 50 to 60% range, then they start to look like Mexico fiscally.
Wow.
So when we think of, they really entered this game saying, let's just flush them out. Let's just, there's nothing like a good, sweating in the oil market. This is Standard Oil. You just get rid of competition.
Yeah. Get rid of the supply out there.
Get rid of the supply out there, and then the returns will be bonanza-like for, it'll be ours again. The problem is they entered this 2 years out. Wait a minute. The U.S. E&P guys are getting more money.
Yeah.
Iran's actually producing lots of barrels,
Yeah.
and somehow Venezuela's, toilet paper or not, they're still there.
Yeah. They don't control the market as much anymore.
No.
Clearly. All right. 3 things I want to achieve right here. You got another chart I want to look at. I want to get to your 2 stocks that you like right now. We were talking about the fact that Saudi, of course, has decided, yes, we're going to do something, and therefore we're going to see production come down.
Yeah.
You've got a chart here showing us the oil production cost curve. Tell me why you brought this one and why it matters.
Yeah, so this one's really important. So I think I mentioned that, we're going to get into a rebalancing. If you don't believe OPEC's going, it's going to be latter half 17. If you believe OPEC's going to do something, it's going to be, somewhere in the first half, probably later, back end weighted of the first half 17. So this is a great graph, just basically shows, it's from BP, just kind of effectively showing a stylized version of the cost curve. And this is how we should think about the way the oil price is set when there isn't a boatload of inventory. So let's, so this is that whole dynamic of why we've said mid-year, why does mid-year latter half 17 matter? Because that's when inventories get into a level that's something that's normalized.
Right.
So when you get into a level where inventories are normalized, supply is close to demand, then you can say, how should we price how should we price oil? Well, it's based on how much money it takes to bring on that marginal barrel of oil. And this is a great graph where it just basically shows you the cost structure of each of the key pieces of oil. So Middle East oil is the cheapest, then followed by onshore, and this would include the U.S., and then shale is there as well. So and then you get into offshore, deep water as the more expensive pieces, and then finally are the good old Canada. So so the way to think about this is if demand proves to be very, very robust, then we really need to tap those really hard to get to places, Canada.
Yeah.
And that would set the marginal price, and that's anywhere north of $70 to $60 per barrel. We think the new normal is somewhere where it taps U.S. shale, the marginal U.S. shale. So once we get into a better supply-demand balance, we should get to a new price point level of $60 to $70 per barrel. And then depending on how tight the market is, because let's not forget, a whole lot of capex has been taken out of the market, specifically from the big international oil companies, that once that comes out of the market, 18, 19, you could end up seeing the Canadian oil, that very, exotic stuff get tapped.
Okay.
Yeah.
I've got here, I think, about 90 seconds. I want to get to them both. Two companies I think are interesting. RDS, Royal Dutch Shell, first one.
Yeah, so Shell, so the theme here is dividends. Get paid while you wait for good stuff to happen. And this is, you get paid quite a lot. so Shell is a great one. The yield is 6.4%. So that's very juicy. It's an integrated oil and gas company. This is a company that's leveraged to higher oil prices. And they're in the middle of a $30 billion disposal program. So when you think about that, that keeps your dividend steady, right? So as soon as they keep selling those bits, that just funds the dividend. And this is a company that's been around for forever.
Yeah.
And so that's why we like that. The next one is Statoil. Again, a dividend play. It's got a 5.3% dividend yield. It's got low leverage. This is a basic just a exploration and production company. They don't really have downstream activity, so that's full leverage to the oil price. The reason we really like this too is this is one of those few very large oil companies that actually has growth. And they've got growth over the medium term. So from our perspective, these are both those graphs look very attractive. They really haven't popped. And when you think about it, they basically both of those companies trade at so Shell's on 13 times PE, Statoil's on 15 times, Exxon is on 20. So from our perspective, it's a no-brainer, and Exxon has half the dividend yield. So, it's just kind of like this, whenever you have these kind of situations, call it the machine, call it whatever, buy, that's why I love these ETFs. They just go and just buy the same thing over and over. It gives great stock picking opportunities.
Thomas, always a pleasure. Thank you. Thomas George, he is portfolio manager of TD Resource Fund and TD Precious Metals Fund.